Something unusual is happening in the silver market right now, and if you are watching carefully, you can feel that this is not just another routine price movement. I want you to imagine standing in front of a control panel where dozens of indicators are blinking at the same time. Some green, some red, some flashing in patterns that don't normally appear together. That is what silver is doing at this moment. Prices are not simply rising. They are accelerating, stalling, spiking, and pulling back in ways that resemble periods of deep structural stress in the global financial system, rather than ordinary commodity cycles. When markets begin to behave like this, the first thing experienced analysts look for is fragmentation in signals, and that fragmentation is clearly visible now. Volatility in silver has expanded far beyond what industrial demand alone would justify. Intraday swings have become larger, option activity has intensified, and physical inventories in major exchanges have been tightening even while paper contracts continue to trade in massive volumes. Historically, this kind of divergence has appeared at moments when the pricing mechanism itself begins to strain, when the paper representation of a commodity and the physical reality begin to drift apart. If you have studied previous cycles, you may remember similar patterns emerging in the late 1970s, just before precious metals entered a historic surge, and again in the early 2010s, when sovereign debt fears pushed investors toward hard assets. In both cases, silver acted as a more volatile cousin of gold, moving faster, overshooting in both directions, and revealing stress signals earlier than most other markets. Silver has always been a hybrid asset, part monetary metal, part industrial input, and that dual nature makes it extremely sensitive to shifts in both financial liquidity and real economic demand. Now, I want you to look beyond the price chart and focus on the underlying forces. Global debt levels are at historic highs, real interest rates remain unstable, and currencies are under pressure as governments continue to manage large fiscal deficits. At the same time, structural demand for silver is rising because of technologies that simply did not exist at scale in earlier decades. Solar panels, high-efficiency electronics, electric vehicles. That means supply constraints and financial demand are now colliding in a way that is fundamentally different from previous cycles. What you are seeing is not just a rally, it is a compression of multiple macroeconomic pressures into a single market. What makes this signal even more significant is that it is not appearing in isolation. Around the world, central banks continue to accumulate gold at a pace not seen in modern history. Liquidity conditions remain loose in many regions, despite attempts to tighten policy. And geopolitical tensions continue to create uncertainty about trade, energy flows, and currency stability. When multiple independent indicators, from sovereign bond markets to foreign exchange to central bank reserves, begin pointing in the same direction, experienced observers pay attention. It suggests that what we are witnessing is part of a broader systemic adjustment rather than a temporary anomaly. And yet, there is a contradiction that you should not ignore. Equity markets in several major economies remain strong. Corporate earnings in key sectors are resilient, and inflation in some regions appears to be moderating. On the surface, that does not look like the kind of environment that normally produces extreme behavior in precious metals. This contradiction is precisely what makes the current situation so important. Markets often send conflicting signals before major transitions, and the tension between optimism in risk assets and stress in monetary assets is one of the clearest signs that the system is entering a more fragile phase. So, what conclusion should we draw from all of this? Not a prediction, not a trading call, and certainly not a recommendation, but an observation. Silver is behaving like an early warning instrument. It is reacting faster than most markets to shifts in liquidity, supply chains, and monetary expectations. When a market with such a long history of signaling stress begins to move in this way, experienced analysts do not dismiss it. They watch it closely because history has shown again and again that the metals market often senses structural changes before they become visible everywhere else. What you are seeing in precious metals right now cannot be understood by looking at silver or gold alone. I want you to step back for a moment and look at the entire financial landscape as if you were watching a storm system forming on a satellite map. Individual clouds do not tell the story, but the pressure patterns, the temperature shifts, and the wind directions together reveal something much larger building beneath the surface. That is exactly what is happening across the global macro environment today. Start with the most important foundation of the modern financial system: debt. Governments across the world are carrying debt levels that, only a generation ago, would have been considered impossible outside of wartime. In several major economies, sovereign debt has moved beyond 100% of GDP, and in some cases, far beyond that. When debt reaches those levels, the system becomes extremely sensitive to interest rates. Even small increases in borrowing costs begin to strain national budgets, forcing policymakers into difficult choices between inflation, austerity, or currency debasement. History shows us this pattern repeatedly, from post-World War II debt restructuring to the inflationary cycle of the 1970s. When debt becomes too large to service comfortably, currencies often absorb the pressure. Now, look at the behavior of currencies themselves. The US dollar, which has dominated global trade and reserves for decades, is still powerful, but cracks in confidence are appearing at the margins. Large economies are experimenting with bilateral trade agreements that bypass traditional settlement channels. Commodity trade is increasingly diversified in terms of payment systems. None of this happens overnight, and none of it means the dollar disappears, but structural shifts rarely announce themselves loudly at the beginning. They begin quietly, with small adjustments in reserves, trade invoicing, and capital flows. Precious metals historically respond to those shifts long before they are fully recognized by the public. At the same time, inflation has not truly disappeared, even though headline numbers may appear to be stabilizing. If you look closely at the composition of inflation, you will see that services, wages, and structural costs remain persistent. Energy markets remain vulnerable to geopolitical shocks. Food supply chains remain sensitive to climate disruptions and trade tensions. These are not temporary factors, they are embedded pressures. In past decades, once inflation expectations became anchored above central bank targets, bringing them back down required prolonged tightening cycles that often triggered recessions. Today, policymakers are constrained in ways that did not exist before because tightening too aggressively risks destabilizing debt markets and banking systems. This brings us to central banks, and this is where the story becomes even more complex. You are watching a world in which monetary authorities are walking a narrow path between fighting inflation and preserving financial stability. On one side, they face pressure to maintain credibility by keeping rates high enough to control prices. On the other side, they see banking systems, housing markets, and government financing costs that cannot easily tolerate prolonged tight conditions. This balancing act creates uncertainty, and uncertainty is the natural habitat of safe haven assets. If you study history, you will notice that gold and silver tend to perform strongly, not only during crises, but also during periods of policy hesitation, moments when markets sense that authorities are losing control of the narrative. Think back to the late 1960s, when the Bretton Woods system began to strain under the weight of U.S. deficits. Think of the period after the 2008 financial crisis, when massive liquidity injections reshaped the global monetary base. In both cases, precious metals responded not to a single event, but to a gradual realization that the rules of the system were changing. Another force you must not underestimate is liquidity. Global money supply has expanded significantly over the past decade, and even when central banks attempt to tighten, the overall level of liquidity in the system remains historically high. Capital moves quickly across borders, seeking protection from currency risk, inflation risk, and geopolitical uncertainty. Precious metals, because they are globally recognized and not tied to any single government's liability, often become a destination for that capital when confidence begins to waver. And yet, here is the contradiction that should make you think carefully. Financial markets, especially equities, still show resilience. Technology sectors continue to attract investment. Employment in several major economies remains stable. On the surface, this does not resemble the early stages of a financial breakdown, but experienced observers know that systems rarely collapse in a straight line. More often, they stretch, distort, and send conflicting signals for long periods before a decisive shift occurs. The late stages of long economic cycles often look deceptively calm to those who are not watching the deeper indicators. So as you stand here with me, looking at the bigger picture, understand this clearly. The rise in precious metals is not an isolated phenomenon. It is a reflection of deeper structural forces: debt, currency dynamics, inflation persistence, geopolitical tension, and the difficult choices facing central banks. None of these forces moves quickly, but together they reshape the financial landscape in ways that only become obvious in hindsight. And the reason markets like silver attract so much attention during times like this is because they tend to react first, sometimes long before the rest of the system fully understands what is changing. Now, I want you to focus with me on something that most people never see, something that sits beneath the surface of headlines and price charts. What is happening in the silver market right now is not only about price, it is about structure. And when market structure begins to change, the consequences can echo far beyond a single commodity. I have watched markets for many years, and I can tell you that structural stress rarely announces itself loudly at first. It appears as small distortions, unusual behaviors, signals that don't quite fit the historical pattern. Look closely at the way silver is trading. The price moves are not simply large, they are erratic. Sharp rallies followed by rapid corrections, sudden surges in volatility, and unusual activity in derivatives markets are appearing more frequently. These are not random fluctuations. In financial history, such behavior often emerges when liquidity conditions, supply constraints, and speculative positioning collide. We saw similar patterns in oil markets before supply shocks in the past, and in currency markets before major devaluations. Markets begin to twitch before they break. But what makes silver different from most other assets is its dual identity. It is both a monetary metal and a critical industrial input. That means it responds not only to fear and capital flows, but also to the real economy, factories, energy infrastructure, electronics production, and the accelerating global transition toward electrification and renewable energy. Industrial demand does not collapse easily, and when supply becomes tight at the same time that investment demand rises, the pressure inside the system builds quietly but relentlessly. Now, I want you to think about inventories. Physical stockpiles of silver in major trading hubs have been declining over time, even as trading volumes in paper markets remain enormous. This is one of the most important signals that experienced analysts watch. When the ratio between paper claims and physical metal grows too large, the system becomes fragile. It begins to resemble a fractional reserve structure where confidence itself becomes the foundation of pricing. And history has shown, from banking crises to commodity squeezes, that when confidence becomes the primary pillar, volatility tends to increase dramatically. We have seen echoes of this before. In the late 1990s and early 2000s, commodity markets experienced similar tensions when physical supply constraints collided with growing financialization. Later, during the global financial crisis, liquidity distortions created violent price swings across multiple asset classes. What we are seeing now in silver carries some of those same characteristics, not identical, but familiar enough to command attention. Another factor that you must not overlook is the growing divergence between regional markets. In some parts of the world, physical premiums have risen noticeably above benchmark prices. Arbitrage flows are increasing, drawing metal from one region to another, and this movement itself can create further tightening. When supply chains begin to fragment geographically, pricing mechanisms lose efficiency and volatility tends to rise. These are the kinds of signals that rarely make headlines, but often precede major shifts. At the same time, derivatives markets have taken on a larger and larger role in price discovery. Options activity, hedging flows, and short-term positioning can amplify movements far beyond what underlying fundamentals would justify in the short run. This is not new. It's been happening for decades. But when leverage builds on top of already tight physical conditions, price swings can become amplified in both directions. Markets that are structurally tight tend to overreact to news, to rumors, and even to shifts in sentiment. And yet, here is the contradiction that you should keep in mind. Industrial production in many major economies remains steady, financial markets continue to function, and global trade has not collapsed. From the outside, the system appears stable, but inside specific markets, energy, shipping, certain metals, you can see the stress lines forming. This is how large systems behave before transitions. Stress does not appear everywhere at once. Oorseer de sanstig bor eer. It appears in pockets, in sensitive sectors, in markets that sit at the intersection of finance and the real economy. So what does all of this mean when you step back and look at the broader picture? It means that silver is not merely reflecting investor sentiment. It is acting as a pressure gauge. It is registering the combined effects of industrial demand, monetary uncertainty, supply constraints, and financial leverage. When a market that historically serves as an early indicator begins to behave in this way, experienced observers do not dismiss it as noise. They watch it carefully because signals like this have, time and again, preceded larger adjustments in the global financial landscape. Now, I want you to pause for a moment and think about where all of this is leading. Not in terms of a prediction, not in terms of a price target, but in terms of direction, because markets, like large ships, rarely turn suddenly without sending signals long before the turn becomes visible. What we are witnessing now is a convergence of signals, and when signals begin to align across currencies, debt markets, commodities, and central bank behavior, experienced observers understand that the system is approaching an inflection point. The first thing you must watch is the direction of real interest rates. Throughout modern financial history, real yields have acted as one of the strongest drivers of precious metals. When real yields fall, or even when they simply stop rising, it changes the entire calculus of capital allocation. We saw this clearly after the global financial crisis, when central banks held rates low for years and hard assets began to reprice upward. We saw it again in the early 1970s, when inflation accelerated faster than policymakers could respond. Today, the same dynamic is quietly re-emerging. Even when nominal rates appear elevated, inflation persistence and fiscal pressures are preventing real yields from rising decisively. That matters more than most people realize. The second signal you should pay attention to is the behavior of the US dollar. The dollar remains the backbone of the global financial system, but its strength is not determined by one factor alone. It depends on relative growth, capital flows, fiscal credibility, and geopolitical confidence. When deficits expand and global trade patterns begin to fragment, pressure builds slowly, almost invisibly at first. Currency adjustments rarely happen in dramatic single moments. They occur through gradual erosion of purchasing power and shifts in reserve behavior. Precious metals historically respond early to that process, long before the broader public becomes aware of it. The third factor, and perhaps the most underestimated, is liquidity. Liquidity is the oxygen of markets. When liquidity expands, assets rise. When liquidity contracts, stress emerges. Right now, global liquidity is not collapsing, but it is uneven. Some regions are tightening while others are easing. Some banking systems are stable while others are under strain. This uneven distribution of liquidity creates volatility, and volatility is often the first visible symptom of deeper imbalances. In past cycles, from the Asian financial crisis to the European sovereign debt crisis, volatility appeared first, and only later did the full scale of the problem become clear. At the same time, geopolitical risks are not fading. Conflicts remain unresolved. Trade tensions continue to reshape supply chains, and strategic competition between major powers is intensifying. These are not temporary headlines. They are structural forces that influence energy markets, commodity flows, and capital allocation. When geopolitical uncertainty becomes persistent rather than episodic, markets begin to price in risk premiums that remain in place for years rather than weeks. And yet, there is another contradiction that you must understand. Financial markets are remarkably resilient. Economies adapt, companies innovate, and investors continue to search for returns even in uncertain environments. This resilience can create the illusion that underlying risks are smaller than they really are. But history teaches us that stability at the surface does not always reflect stability underneath. Before the global financial crisis, credit markets appeared calm. Before the collapse of Bretton Woods, exchange rates appeared stable. Before the inflation surge of the 1970s, policymakers believed the system was under control. In each case, the warning signs were visible, but only to those who were looking in the right places. So, as you stand here with me, looking at these signals, the behavior of real yields, the slow shifts in currency dynamics, the uneven flow of liquidity, the tightening of physical commodity markets, and the persistence of geopolitical risk, you begin to see the outline of a larger story. This is not about a single metal or a single market. It is about the gradual transformation of the global financial landscape, a process that unfolds over years but reveals itself in moments of volatility, like the ones we are seeing now. And this brings us to the most important point of all. Markets do not move in straight lines, and history never repeats in exactly the same way, but patterns exist, cycles exist, and when multiple indicators begin to align, when debt is high, currencies are under pressure, liquidity is unstable, and safe haven assets begin to behave unusually. Experienced analysts do not ignore those signals. They observe them carefully. They compare them with history. And they understand that the most important developments in finance are often the ones that unfold slowly, quietly, and almost invisibly, until suddenly everyone can see them at once.